Management's Ali McCartney and Phil Camporeale from JPMorgan Asset Management. Ali, what are you telling your clients right now? I know you've been a fan of energy, but energy today not faring too well, down 5.6%.
Look, Sarah, on a day like this, nothing fares well. We have had two really tough days. Ultimately, I think the subtle change in what we saw Friday and today comes from the fact that we have had a lot of mixed data. It depends on who you're talking to, at what point in time, and to how you can interpret it. The data that we got last week, everything from the lowest consumer index level ever at University of Michigan to something from the CPI that confirmed that the narrative that we hit the peak in March is not, in fact, the narrative. So everything that has been priced in based on interest rates, based on the expectation of inflation, is now undergoing, what is the new normal and where are we going to be? So this is just a risk-off day, and I'm telling clients to try to just hurry up and wait and understand that this is going to be a long process that took 14 minutes of a lot of money and a lot of free money in the system. And we all just have to practice humility and discretion and discipline when it comes to investing at this point in time.
Phil, it does raise the question as to how long this type of bear market we're in for. What does this look like to you? Is there any historical comparisons that you can give between maybe the hiking cycle, where we are in the economic cycle, and what we've seen for stocks?
Yeah, Sarah, we need to stop meeting like this, which is interesting. The historical comparison that people are drawn to is either the late 70s with the Volcker moment or 1994. But listen, over the past couple of trading days, this sell-off has entered a new phase. The conventional wisdom as we came into this month was that the Fed would hurry up and get to neutral. So they would still go 50 basis points over the next couple of meetings, stop at about 3% and look around. And hopefully at that point, they would see that meaningful reduction in inflation. That's out the window now, Sarah. I mean, we've seen an additional 70 basis points of tightening over the last two trading sessions priced into 2022 alone. And as Ali was saying, there's absolutely nowhere to hide, which is so jittering to investors. Sarah, do you realize that the worst year bonds has ever had, as identified by the Bloomberg aggregate, was down negative 2.9%? We're down 11% in the aggregate year to date. Like, nobody's really seen anything like this. And what we're telling clients is, listen, if your time horizon is a long time horizon, you're going to be fine, right? But over the next couple of quarters, this is not the time to be a hero. We do not see a bottom in the equity market. There's nothing that tells us that the equity market has bottomed. So from our perspective, it's a meaningful underweight to stocks of about 10% in a 60-40 portfolio. And we're trying to figure out what to do with our corporate credit, which is acting a little bit more like stocks than we want it to right now. But buying puts on the S&P 500, which we've had in the portfolio for a couple of months as a hedge, is the only thing that's working right now.